morning, everyone, and welcome to the 82nd episode of the Veritas fact-finding series. And this morning, I'm joined by Dr. Ron Dembo. Good morning, Ron.
Good morning, Anthony. Thanks for inviting me.
Oh, it's just really excited to have you on. We designed this program in the wake of the COVID pandemic as a way to find the truth. In each episode, we go on the ground with industry professionals in an unscripted, candid video format to better understand how the pandemic will affect the future of our economy, our life, and of course, our investments. By way of background, my name is Anthony Scilipoti, and I'm the president and CEO of the Veritas group of companies. And I'm proud to say this year we're celebrating 20 years, 100% employee owned and operated. During this series, and with everything we do, we believe the truth comes from the facts and that better information leads to better investment decisions. Just a quick disclaimer, this broadcast is not to be taken as investment advice, and participants or employees of Veritas group of companies may own securities discussed in this broadcast. While we love all our guests, and of course, Dr. Dembo especially, the session may contain forward-looking statements, investment opinions, and comments that we may not agree with at all. Now, I need to spend a moment, and I could spend probably just half an hour talking about Ron, but I'm going to do a quick synopsis for us. So Ron is one of the world's leading authorities on risk management. He's not only an academic, but he's an entrepreneur, and he's a consultant to some of the world's largest corporations and banks. Now, he started, by his count, 5 businesses. Now, there could be 6, but at least 5. One interesting one, Riskthinking.AI, is a company dedicated to science-based measurement of climate change and financial risk. And we're going to focus on a lot of that in our discussion today as we discuss risk. He's also co-founder of Climate Risk Labs, an initiative to create worldwide network of research institutions working on the intersection of finance and climate change. And I want to also mention that he started, and it was CEO of Algorithmics Inc. That was a business that was sold to Fitch in 2005 and later to IBM in 2012. So for those of us listening and want to understand about investing, want to understand about business, and want to think about how do we manage and gauge and evaluate risk, that's what we're going to be talking about today. I'm going to make a strong pitch. I have mine on order. But I make a strong pitch that you pick up the book, Riskthinking. This is Ron's 4th book. He's very prolific, also writes a number of articles that get quoted frequently on measurements and statistics and risk management. All right, before we get going, last bit of point I'm going to make. There's a quote from the, I'm going to take from the book that's just been recently published. And I think this sets the tone for what we're going to discuss today. In our age of radical uncertainty requires a new way of assessing risk that pays more attention to the extreme outliers that too often become tomorrow's reality. Today's models cannot cope with the frightening new unpredictable risks we face every day that frequently seem to come out of left field. The effects of climate change, a killer pandemic, a cascading wildfire, a financial crisis triggered by faceless algorithms, or a devastating cyber attack that shuts down the entire electric power grid. I mean, we've just described the last 20 years, and lots of those have happened in the last 3. All right, so Ron, and it's okay if I just call you Ron, right?
Sure.
And most especially, I have to say, Ron's a Canadian. So I want to just make this point. Ron, I always like to discuss, to start out with our guests, tell us about yourself. What brought you to where you are today, and to the passion that you have helping companies, helping governments deal with evaluating risk?
Well, I was a kid raised in South Africa, for one thing, and what brought me to climate was my dad, who used to take me to the game reserve. We'd go out alone there. It was very primitive. You could see the stars like I've never seen since. And, you know, we spent time looking at animals, listening to them at night. He turned me into a real tree hugger and climate guy. And so I just cannot stand when we destroy the world and destroy biodiversity, and that's got me to risk thinking. But risk itself was a, a combination of events. I was a kid of the 60s and, money was dirty. And I got one day I was walking into my office at Yale, and the guy next to me was a Nobel Prize winner. And he said, why are you consulting to engineering companies? Why don't you go and consult to Wall Street? They'll pay you more money. It's much more interesting. And I said, okay. And he got me a couple of interviews, and I took a job at Goldman Sachs for the summer. I mean, you got to put it in context. I was earning less in a month. I was earning less in a year at Yale than in a month at Goldman Sachs in the summer. So I thought this
and
is.
now you're already a professor teaching, or you're still a student? You're already a professor teaching.
I was a professor, yeah. And so that I got this job, and I walk into the office, and it was a job given to me by Rubin, who was then later on the Secretary of the Treasury. And it was a very flat organization, quite small. It wasn't top of the line on Wall Street, but very entrepreneurial. And so, I get in there, and they give me this partner's office, and I sit in this partner's office, and they say, do whatever you like. And by the way, they're paying me a lot of money, more in a month than I earn in a year. And after a few days, I walk out onto the floor, start looking for problems. And I get called into Rubin's office, and he says, I've got this problem. I've given it to every professor in finance and economics, and can you solve it for me? So I said, give me a day. I'll noodle on it. I come back the next day, and I say, you know what, if you gave me $1 million and a couple of months, I think we could save you $17 million a year. He says, okay. I thought, wow. He said, okay, just like that. And that was my first true experience of a super entrepreneur, super risk manager. He was really great. I didn't save them 17. It was only something like 13. And we didn't spend $1 million. I only spent about 400,000. But anyway, it was my start in finance. And there's a couple of other things that are funny. I don't know if you want me to tell them, but so I used to commute from Toronto to Goldman, and I had one day I get there, I'm in torn jeans, and the flight's delayed. So I get to New York about 1:30. I have to go to my apartment to change, but I say, I'm going to miss the whole day if I do that. So I walk into the office, I sneak into my office in torn jeans and a torn t-shirt, and Rubin shows up, and he says, you know what, I've got a delegation from Repsol Petroleum, really big company.
I know it.
And, I need you because you were a chemical engineer by training. You know about refineries, you know about, mathematical modeling, just come. And I said, can I come like this? He says, sure. I go into the room, and there's all these guys in blue suits around this big table, very fancy. And I walk in like that, and they must have thought I was some kind of hero to walk in like this. But about a year later, after I do speak Spanish, so I understood their comments. No one else in the room understood what they were saying behind Goldman's back. A year later, I get a call from the president of Repsol, and he says, you know what, I've got this risk problem. 4 people in my firm, 35,000 people, are responsible for 40% of the bottom line. And I'm worried they could go the other way. Good risk thinker. So I took that, I got a retainer. I started a company with that retainer called Algorithmics. It was in my backyard, it was me alone. I used the retainer to hire 1 or 2 junior people. And that became Algorithmics, that had 70% of the top 100 banks in the world, about 850 people, 15 offices around the world, and so on. So that was my major claim to fame at that point. I never thought I'd be a businessman. My father always wanted me to be one. He was kind of sad when I took a job at Yale.
Imagine.
So that's how I got into risk management.
And before we get into the depths of your work, well, to summarize, what is the key to being a successful entrepreneur?
I think it's being able to listen, being able to take advice, not always being right. But the most important thing is to surround yourself with very clever people. And I usually, when I hire on the basis of smarts, culture, and then the rest is gravy if they know the domain and so on. So I had some extremely smart people working with me. They've all gone on to form their own companies and have done extremely well. There's a whole ecology of people out there, ex-algorithmics. But the nicest thing for me ever was a few years ago, I put out a message on LinkedIn and I said, happy birthday, Algorithmics. It was 30 years. And I got under 48,000 hits to that in a matter of a week. Wow. And, we never had 48,000 people. So that came from customers and it was uniformly how people have never found a place to work in that was like that since. They loved it. They formed bonds there. So, I think it's about people. You really have to value people and value smart people. And the biggest negative thing, though, is if something's not working, probably my biggest mistake was not dealing with it quickly enough. I've learned that,
Me too. I would say that's the toughest thing, because to make a shift, especially when you're the leader making the ultimate decision, is an admission that you were wrong. And that's why we struggle with it.
Yeah.
So let's transition to the work that you've done and help us to think about risk. So I remember in our discussion I think we spoke for about an hour, but I could have spent 3 or 4 hours in our prep discussion. And we talked about how, the common way that, especially obviously in our industry and governments, forecast. And so I think that's a good starting place. Maybe we could compare your way of thinking of how to think about the future compared to what we typically do when we forecast.
So, the best way to describe that is with a couple of nice stories.
Sure.
There was this guy who was running the Shore Festival. And a couple of years ago, it's more like 6, 7 years ago, he took out an insurance policy in case there was another pandemic like SARS.
Yeah.
And, his CFO said, well, wait a second, why are we doing this? It costs money to do these things. And he said, no, like we've had SARS, another one could happen. And if they could shut us down, and, what are we going to do? Oh, we've got employees. We want, there are people who not living on, fast life. They need this money. Mm-hmm. And along comes COVID. And everybody else is out of a job, but everyone in the Shore Festival is getting paid. You think of it, Shore Festival, and this guy's probably one of the best risk managers I've spoken to. Because what he's thinking about there is he's not forecasting that in the next 5 years we're going to have a pandemic. He's saying that here's a scenario that could shut us down. It's unlikely, but you know what? If it does happen, the consequences are so great and so onerous on my staff that I'm going to take out a hedge, and the hedge is an insurance contract. So that is what risk thinking is about. It's you don't forecast that COVID's going to happen. You generate scenarios. Could it happen? Yes. And if it does happen, what'll happen to you? It's extreme. We might have to shut down the Shore Festival. Just like think of all the restaurants that have gone out of business, So that epitomizes risk thinking. It's the combination of scenario thinking with hedging or mitigating the risk. But another good example of how not to risk think is our government choosing how to make its own vaccine. So what happens? You imagine the Privy Council gets called, we got to make our own vaccine, what are we going to do? And someone goes off and comes back and says, you know what, I've got this great company in China, they're ex-Canadians. What we could do is we could get the basic ingredients from them and manufacture it here. Okay, guess what that is? That's equivalent to putting all your eggs in one basket. You know, we know you shouldn't put all your eggs in one basket. That's not good risk thinking. So what happens is, you know, if they did that as in a risk thinking way, like the Shore Festival guy, they would have said, you know, let's look at a couple of scenarios. I mean, is there a chance that there's a political risk with China, that they might just shut off that supply? Yeah. You know, we've seen China do that before. So it's not off the wall. Maybe even if you think it's unlikely, what would that effect have on us? And guess what? Guess what happened? So we don't have our own vaccine.
Yep.
But the second thing is, you know, if we just had SARS and it was so onerous on us, it hurt algorithmics, by the way, SARS. Why wouldn't we have built our own vaccine capability? You know, we've experienced that risk, you know. So the trouble in many government situations is decisions are made on forecasting. I'll give you another example. In 2018, in September, there was a meeting of our central bank, and our central bank said, you know what? By March next year, our GDP will be 2.4. And by the way, it was 2.4 in September that year. So guess what they were doing? A bit of extrapolation.
Yep.
Well, a risk thinker would have said, well, what if it's not going to be 2.4? What if it's 0.4? And guess what that's going to do to our budget? I mean, we're going to blow right through the budget. We're going to have to raise money on the markets. We're going to incur more debt. And, you know, that's not a good thing. Won't be good for us in the elections, whatever. But they didn't do that. They made the forecast. And guess what? In March of that year happened. It was 0.4.
Yep.
So we blew through the budget. So risk thinking would have said, if that's such a big consequence, even if it's unlikely, hedge it. Because it's cheap to hedge things that are unlikely.
Especially when there's very little chance of them occurring.
Yeah. Because that's how the market prices them. Correct.
The price of pandemic right now, insurance, is very high.
Yeah. Think of, think of other kinds of situations which are much more extreme. You know, Pacific Gas and Electric, the biggest utility, one of the biggest utilities in the world. You know, most of California is under their control. And, you know, along comes if you looked at a map of where all of their transformers are and all of the power stations, it sits right, you know, the transformers go right through dry forests. So when you have a situation like dry forest, you know, drought, high winds and high temperature, think climate change, okay? And which is happening in California, it's an epicenter of climate change.
Yep.
Guess what happens? You have a fire. Guess what happens if your transformer lit that fire and it happens to burn down a city and people die? You get sued. So Pacific Gas and Electric went from 23 billion to 3 billion in bankruptcy in weeks. So, you know, that's now risk thinking would have said, you know, is there a chance that one of our transformers could light that fire? And if it does, could that fire jump over the 101 highway? It's 12 lanes. And so you got 6 guys sitting around a table dreaming of scenarios, and they say, nah, it's never happened in all of history. But if you were risk thinking, you would have said, you know what, let's look at other situations that are similar to ours. Could that happen? And turns out in Ventura County, down the road, a couple 100 miles, 12-lane highway, same highway, fire jumped across that highway.
Wow.
So, and there's one more story, and this is very important for Canada.
Please.
Ed Clark was running the TD.
Yep.
And Ed Clark said to me, and I think he's one of the best risk managers we've ever had. He said, the way I look at risk is I don't go like my fellow CEOs and look at, likely events that have a high impact. I look at unlikely events with high impact. And that's how he actually saved the TD during the crisis in 2008. He got rid of all the stuff that killed everybody else. They were making lots of money. And when he did that, people said, this guy's going to screw up this bank. I mean, everyone's making money with these things and he's killing it. But TD went from 70th in the world to 7th in the world because of that. Anyway, I could go on.
Oh, listen, that's wonderful. I think the best way to learn and to understand is to hear stories, because that makes it and especially when they're so close to home. Maybe we could take this now to the discussion, which is really at the heart of the work, a lot of the work that you're doing today, which is related to climate change. And if perhaps we can start with your assessment of what we're doing with it, and then what should we do to deal with this challenge that we're faced with. And being Canadian and Canada, this is so important both to our economy of today and the future.
I don't think you can have any idea of how important it is in a way. In Canada in particular is extremely vulnerable. Mm-hmm. The good news is that we're a rich country and we can usually get out of doo-doo by just buying, by raising money, and devaluing the dollar. But anyway, the story is that our traditional activities have involved fishing, forestry, agriculture, mining, and we've made a lot of money doing that. But with climate change, the oceans are heating. So where we used to fish may no longer be possible. Mm-hmm. The forests are warming up in British Columbia, and what we see in California might be happening in British Columbia soon. Already, the pine beetle's eaten up half of the pine forests due to it managed to migrate into Canada because of the climate and is attacking the boreal forest. So we have tremendous, wonderful resources, but we are extremely vulnerable to the climate change because where we used to grow wheat, we might not be able to grow anymore. And there's been these flippant kind of remarks that, we'll just grow it further north. We could never do that because it would produce so much carbon that it wouldn't be possible in a carbon reduced world. We've mined the tar sands, and that might become a stranded asset. But there are scenarios where carbon capture becomes so cheap, and carbon capture and storage, like for 3 cents a ton of carbon, you could just put it anywhere and get rid of it, and carbon won't be a problem. It's a very long shot. So there is a possible upside, but most likely carbon is going to become a very, very expensive commodity. And we won't be able to produce stuff out of the the tar sands, and no one's going to buy it, and we won't be able to produce it. And fishing might be impacted, and agriculture might be impacted. So all of our major sources of revenue might be impacted. So you might say, okay, well, it's a long shot, climate change, it's far in the future, whatever. But there is a possibility that we will be violently affected. So what would you do in a risk thinking way if you're running this government? You'd say, we have to hedge that. we are doing things. We are talking about them, but the rate and the extent of which it's happening is probably inadequate. So, I'd say that we have to be hedging those risks all the time. Now, the good news is that in Alberta, just in the last year, we've put in a lot of renewable energy and might turn Alberta into a hydrogen producer instead of a tar sands oil producer. And that is the kind of risk thinking you want to do. You want to say a big hedge against future climate problems would be to actually look at what future energies might work well in a carbon intensive world. And hydrogen is one of them. And you can make what's called green hydrogen by taking excess energy, excess electricity, and producing hydrogen. So what's excess? You put in a whole lot of windmills and they generate electricity sometimes when you don't need it.
Yep.
Take that excess, instead of letting it go into the sky, you take that energy and you produce hydrogen with it. And that's hydrogen that's so-called green. It didn't produce carbon in its manufacture. And that's the kind of thing that we should do. That's a good example of risk thinking.
Now, there's discussion that we should just shut down the tar sands. We should stop producing because there's just too much carbon, et cetera. What are your thoughts on that?
I think you could hedge that. And one hedge on that is if carbon capture was truly cheap and ubiquitous, then they might not be such a problem, and we could actually still produce there.
How do you do that?
Well, we put a lot of research into carbon capture and storage. We're doing some. And we've actually, one of the assets Canada has that's fantastic is we have fantastic universities, top in the world. We have fantastic architects, engineers, material scientists. AI is very strong here, and tech. We can build things and do things. I'll give you an example of a thing that we've missed. Back in 2005, I went to the Ontario government with a proposal that we turn Ontario into one of the capitals for retrofitting buildings in the world. We have the perfect situation here. We have all these multifamily housing units that were in relative disrepair, very inefficient, needed to be retrofitted. And we have all the architects you could want, all the material scientists, all the engineers, we could do it. And every city in the world needs to do that today, because 90% of what you see here today will still be here in 2050. Mm-hmm. And we could have done it. We could have owned that. We didn't.
Can we still fix that problem?
You could try.
So I just want to remind everybody, if they have a question for Ron, to just scroll down to the bottom of your screen over the Q&A and type in the question, and I'll make sure that we address it. Thank you. Okay, I want to discuss something else which is related to all of this, and that's ESG.
Yeah.
Our entire industry is now shifting, moving, contemplating. In fact, I'm involved with the International Accounting Standard Setters, and we're going to be putting together a new board, a sustainability board, to look at the measurement of sustainability. What sort of things should we be thinking about? What are your comments on ESG? I'm leaving it open because I know that you can take this in many different ways.
Well, look, ESG is important. ESG, as it's practiced today, has a lot of challenges. It's a euphemism for saying it's not exactly working like we'd like it to. There's two parts to ESG. One is, what I would call just good business. You shouldn't hire slaves. You shouldn't build in factories in Bangladesh that could catch fire easily. You should respect your people. You should, treat people well, good maternity leave, whatever you need to do. That's just good business. And then there's the E part of ESG, which is the environmental part. And that's the weakest part today. It's that organizations today have a really big challenge in not being able to measure the environmental risks well. And the good news around this is that this is going to be regulated. It is being regulated already, and it's coming down fast for banks and for corporations. Already in England, every corporate has to produce really good risk analysis or be penalized. So, climate risk is here to stay, and it is recognized by the regulators, and people are worried. But the quality of measuring climate exposure, the E part of ESG, is a very technical thing. It's not trivial to do that. It's an extension of classical risk management. It involves a lot of mathematics, a lot of data, and so on. And the ESG used to be treated as, well, we've got to have one of those in the bank, so let's just put it there and we won't give it any budget and let them have fun.
Yeah.
And then we can tick that box. It can't be like that anymore, because there's a huge reputational risk and enormous investor pressure. For example, we're dealing now with one of the largest custodians in the world and enhancing their ESG product to actually measure climate risk. In this custodian has something like 40% of all the traded assets in the world, the investment assets in the world. And they will all be getting, a pretty thorough ESG, E part of ESG. There's also E that generates S that generates G. Let me give you an example. An environmental risk, for example, a risk. We're in a La Nina situation now. Sometimes you have El Nino, La Nina. These are all climate drivers.
Yep.
And when some of them occur, you might have drought in Australia and rain in East Africa. And when a reverse occurs, it gets dry in East Africa and rain in Australia. So just today, there's a paper out on how tons of rain in a developed country really affect the economy. If we get much more precipitation than we used to. But it also, the drought in Australia set off massive fires, which then killed billions of animals. Biodiversity got damaged, which then caused, social upheaval and so on. The rain at the same time that occurred in East Africa caused mudslides, affected food production, and most people there are living on, small plots of land growing their own food. So environmental risk generates social and governance risks. Where's the governance part? If you're a pension fund or investing in, as in Australia, investing in companies that might be affected by environmental risk, climate risk, and you don't take that into account in your investment process, you could be sued. And that's the governance risk. So E does generate S and G, and that's just starting to be recognized.
Do you think we can measure it? Like we're so fascinated with measuring everything, right? Whether it's earnings, revenue growth, margins. And so we have to, of course, have an ESG score, right? We've actually had a few interesting professors who you might know, but Charles Cho, we had him, we interviewed him last year, and he was talking about this, how there's greenwashing and ESG washing and the way that it's all being done. So do you think we can measure it and actually come up with a number?
If you saw a credit score like Moody's says that Canada's downgraded to AA. S&P would be very close to that, and so would Fitch and so on. That wouldn't be that Moody's thinks we're a AA, but S&P thinks we're a BBB.
Yeah.
Now in ESG today, if you went out and got a whole bunch of ESG scores from different companies, one of them's in Toronto, you would get them all over the map. You could, I mean, I can give you an example of one interesting ESG, one of the top ESG, in one of the scorecards, one of the top ESG scores was given to a company that does massive environmental damage. I don't want to mention the company's name, it's not fair, but you know, amongst environmentalists, you look at this and you say, are you kidding? You know, like this company is a top in my sustainability company. So I think it has to do with the metrics and the way in which ESG is measured. So that's one of the problems. The other problem with ESG is it's not actionable. In other words, you know, you would like to have measurements because you want to actually take actions. And some of the ESG measurements are not that actionable, you know. So whereas a climate risk rating is actionable. I mean, I can tell you, you know, I rate Canada a D3, which means there's 3 times more likelihood that we'll be hit negatively than positively. And we can take an action. We can move that to a U score. U means the upside is going to be more in our favor than downside. So, you know, you really want to measure if you're going to action with those measurements. Today, ESG scores are a lot of ticking the box.
I'm going to just, again, in the interest of your time and those of our listeners, I'm going to launch our poll so everyone can tell us what a great job you've done. Ron, it's really been a pleasure, and I don't want to let you go yet. I'm going to actually introduce you to the if you haven't been working with the International Accounting Standards Board, I think you should work with them as we're putting together this new sustainability board. I think having some of your insights and the insights of your organization would probably really help. But this ticking the box, those I mean that are listening quietly are not going to say anything, but I know that this is rampant in our industry. I guess if you could leave us on a note that says, what do we need to do in order to pull this together so that we can come up with scores that mean something and implement it in our investments in a way that's going to make a difference and improve not just the lives of not just our returns for our investors, but in the greater return, the return for our society.
So look, the fact that we're doing this is really great, that we really want to improve the social and the governance and so on of businesses. It's great that it's happening. What we need is regulation that makes sure that when you see a score, you know, it's appropriately calculated. You know, there's something behind that. And today we don't have that. So, I mean, look, when you see a credit rating, you're going to know that credit rating is probably meaningful.
Yeah.
And to rate a credit is, or to measure, you had made the point about measurement. You know, to measure credit risk is equally difficult than, you know, I mean, like, is this guy going to default, my next door neighbor? How do you know? You know, so we have ways of doing that. And we're pretty good at that. We're good at measuring some complex things. We're pretty poor at other things, like measuring climate risk today. And
measuring social, like how do we measure the risk of social?
So you can
governance. These are really hard things to get a hold of.
They're hard, but you can do it. You know, there's a tremendous amount you can do with AI today. And one of the things that I think is really interesting, you know how it's quite often in business, you hear people saying, don't boil the ocean. But with AI, it's actually just the opposite. You boil the ocean because we've got lots of computers. It's pretty easy and cheap to boil an ocean. By that, I mean, you can put together a knowledge graph that links everything to everything else. And we do that today in our company. And now you can mine that knowledge graph with AI. which is, another machine working on what you've done is taken unstructured data and made it structured. And we can say, for example, that a fire in Australia will have these implications to GDP and biodiversity and social. A flood in East Africa will have these social consequences. A drought in Northern Sudan will have these social consequences, because we've seen them before. Take Vancouver.
Yes.
Heat stress in Vancouver caused 700 deaths in a week. We know heat stress is going to be coming because of climate change. Toronto, the number of hot days in Toronto will treble over the next few years. That is days when it's, our railway lines could buckle permanently. So we know these things are coming. We need to start risk thinking. That's the way I think about it.
All right. The last thing is any thoughts on how we should think about how this pandemic ends, or how we should consider that?
I'll give you one scenario that is not that unlikely and is extremely negative for where the pandemics will end. Most of the world is not vaccinated. When COVID hits Africa, it's a clever little guy. It morphs into COVID-20 instead of COVID-19, or our latest one. So until we vaccinate the world, the odds that we're going to get another pandemic are very high. And that's the risk that the developed world is facing. So us hoarding vaccines and vaccinating our own people at the expense of other nations is going to cost us.
We need to be taking a look at where the potential risk is very high of a very low risk of a very bad outcome,
yeah.
and deal with that. And that is
our hedge against another COVID is vaccinating the world.
Yeah. All right. Doctor, a fascinating discussion. I wish you continued success. I will introduce you for real to a number of different organizations that I think could use your help. Quick plug here. We need the Steelers on Sunday, big. And I thought I'd wear my cufflinks today. These were given to me by a native friend. This is a wisdom and perseverance symbol. So we need a lot of that for our environment.
Okay, thank you so much for the invitation.
Thank you, Doctor. All the best.
Bye.